Prateek Agrawal joins us, Executive Director of Business and Investment Strategy with Motilal Oswal Asset Management. Prateek, good morning. Thank you for joining us. How are things? Are we out of the woods? Do you think markets have bottomed out?
I think the carnage that you saw in the market was on a large part on account of technical reasons, such as US 10-year yield moving up sharply from 3.7 to over 4.8, such as our currency taking a knock from 83, 84 levels to wherever it is just now, making levered investors, having to reduce positions, square off positions, and hence what you saw was the part which did very well in September to December, taking a large knock. If that is behind, yields have started to drop, currency is stable at a new level, then the same place which saw a large knock could be the places to hunt for new ideas. Especially if you get a combo of a large correction with strong quarterly growth numbers in front of you.
Okay. Why in this market IT is down and banks are up?
Yeah, so IT and banks, the narrative changed. These are spaces in the market which shall probably not grow faster than the index growth in itself in earnings. Over December Jan period, the narrative here changed. The whole thought was Trump comes, reduces taxation for corporate America. There would be some money surplus, and Indian IT, the outlook shall improve. As of now, the tax cut hasn't happened. So versus other spaces, the outlook hasn't really improved. Banks, once again, the outlook improved in that period when they thought was US yield will stay higher for longer. Now, while there is this thing of higher tariff and hence higher inflation, but bond yields have started to come down sharply, and in India, there is a talk of further rate cuts. So both of these spaces, while interim banks may be up, IT may be down, that keeps happening. But I think both of these spaces, which held out very well in the Jan-Feb period, could see underperformance as we go forward on a relative basis.
Right. Very good morning to you, Mr. Agrawal. This is Sharu also joining in the conversation. I wanted to get your sense actually on these narrative counters. And narrative by narrative stocks, I mean the entire PSU pack, the defense, the power. All of these counters actually saw a substantial correction over the last 4 to 5 months in line with what the markets were anticipating. In fact, they corrected much before the markets actually could see that sort of a correction. What's your take now? Do you think that they've reached a level where you can actually start looking at these stocks and they can be a part of your portfolio right now again?
So I oversimplify it. I say if they were doing well in September to December, they have taken a large knock now, and earnings outlook hasn't gotten impaired. I think chances of that space doing well is very high. Now, if something has done well in Jan to September of last year, that space has also taken a knock, maybe a tad lower than what did well in September to December. And I think uptick there also should be expected, but maybe to a lower extent.
Right, so that's the take coming in on these counters. So if I have to break it down and if we have to talk about that space particularly and that narrative counters particularly, so which is that sort of a sector that you will bet on out of that? Because I remember last that you spoke to us, you did speak of the fact that you like the renewable energy space as well, and you also like some of the defense and EMS space. So do you think that your pecking order or your picks will remain the same now also?
So we continue to like these spaces. They are the earning growth leading spaces in the country. I think this quarter also one should expect to see strong number from many of these spaces. So yes, we continue to stay positive on them.
Have you changed your position? You were underweight banks. I mean, I remember we had a chat 6 months ago. Have you changed that position?
No, so we continue to stay underweight banks. We are growth investors. I think one of our kind in the country. We typically don't go to spaces where earning growth would be lower than that of the index. So I think spaces like cement, construction, all of those very, very close to GDP related spaces would deliver numbers close to overall averages. That includes bank, IT, large IT, and those are spaces which are very little in our whole house.
Pockets where you think that the growth could be above nominal GDP. I'm assuming nominal GDP is 13-14%. So if you're hunting for pockets of superior growth to a GDP, which are the pockets where 3 years 15 to 18% growth could be there? And I'm talking about profit growth, not top line growth.
Yes. So your colleague took some of those names. So we think renewable have a good 2 years of very good growth visibility, as does EMS, as does luxury. NBFCs in lenders, capital marketplace, some of them will do that. And yes, defense, I think some of the names in cap good side shall also do that. So that is what is a lot of our portfolios.
But isn't the renewable space a highly regulated sector? Stroke of a pen or push of a button, the protection goes away. And I mean, markets would say, 2 साल के बाद क्या फिर?
Yeah, no, so there is a macro to it. Many of these spaces where there is a policy tailwind, that tailwind is there because of certain factors. Electronics, let's say Make in India thought, how much you import, is it strategic? Do you want to, gain indigenous control over the supply chains and so on? So unless something very bad happens and you are forced to not do it, I think these things are very, very long term. So the risk of policy flip-flops here should be very low. That said, any of these spaces that we have spoken about, if you look at our portfolios, you have a scatter of names, nothing more than 2-3%, I think is what we have. So we run very flat, though high conviction portfolio.
Prateek, what's the take on real estate right now? And this just, in light of the note coming in on DLF just this morning, that sales perhaps may actually begin to show a more modest growth, while structurally, of course, real estate continues to be a good story. What is your own sense?
No, so real estate, we tend to look at Delhi real estate slightly differently versus Bombay real estate versus Bangalore real estate. I think we do suspect some amount of higher investor traction in the north versus other parts of the country. But this is a space which will have tailwinds as interest rates go down, just like NBFCs benefit, real estate also benefits from better, buying intensity by people who may be on the sidelines and for whom, 0.25, 0.5 rate cut swings the decision in favor of buying. So real estate will have rate cut tailwinds.
Right, so that's the take coming in on the entire space. But Prateek, also I wanted to understand, Mr. Agrawal, I also wanted to understand what's your take coming in, especially when you talk about this entire gold financier theme and the gold related counters, given the fact that you have the gold prices now at record high levels. You have the Manappuram and Muthoot, both of them actually doing exceedingly well, is given the fact that business also has been doing well. Are you looking at these pockets and if you have to play this entire asset quality of gold as a theme, how would you play it?
On the active side, we have largely given it a miss because we find ourselves unable to predict the direction of gold prices. This is a business where gold prices is a significant part of overall business growth trajectory. And we have seen that happen in the past. That is what has kept us away. But that said, gold as a security is a very nice security. It doesn't go bad. The lending is completely secured. So if these guys continue to grow well, then I think these are probably the safest NBFCs. So that is the thought. But in equity, where we see growth, if you don't have a handle on where the commodity price would be, gold price would be, very tough to be invested in a space.
So apart from renewables, which are the other pockets of high growth where you think that there could be a combination of P expansion as well as earnings growth? I mean, where do you see this happening? A 15-18% return for next 2-3 years, where else can come from?
So I think a lot of the names we took, many of those spaces, if not all of those spaces, should offer that combo. See, there was a price in December. I thought that prices were sustainable. Even if they were not, the knock that many of the names have seen are in the vicinity of 30 to 40%. On the reverse, that 30 to 40% is a 70 to 80% kind of an uptake. And time has passed, so the valuation thoughts would have also moved. I think, which is why I'm saying, spaces which have seen a large knock and where earnings growth trajectory would be largely maintained, some places it may be strengthened. Are these spaces to really focus on?
Okay, Prateek, great to have you on the show. Thanks as always for your time.
Thanks.
If you like this video, then like, share and subscribe to ET Now.